Hi folks, welcome to this video on ratios. In this case, what we want you to be able to do is to use the data we give you in order to compute or calculate some of the ratios. So we're going to be asking you to calculate some of the ratios for this company. Now, one of the things you'll get on your exam is you'll notice it will be attached some ratios that you're going to be able to use for financial analysis. So we name the ratio and give you the formula. We don't tell you what it means. And this is what your formula sheet should look like. So as we scroll down, you're going to see some of the formulas that you're given here. So in any case, we're going to be hopping back and forth onto this with this formula sheet just to make sure that you know where to find your formula, right? And how to plug in the numbers. So let's get back to our question. We've been given some information here from the income statement, net sales revenue, and don't forget, if net sales revenue is at net, it means it's deducted from sales revenue, sales returns and allowances, and also deducted sales discounts, cost of goods sold, and net income. We've also given you some comparative data for the balance sheet numbers. We have the balance sheet numbers at the end of January 2013 and the end of January 2014. So what we need you to do is to compute the ratios for the year ended January 2014, and these are the ratios we want you to be able to calculate. Now in this question, just to help you remember them a little bit better and why they're important, I've always also asked you to interpret the meaning of the ratio. So tell me what it means and what it means given what you've calculated for it. But we'll show you what we mean when we do our example. So now, asset turnover ratio is the first one we've asked you to calculate. So the first thing most students would do is they'd go to their formula sheet and you'd say, oh, asset turnover ratio is net sales revenue divided by average total assets. So if we go to our solution, I've actually given you here the formula. Net sales revenue divided by average total assets, because we want you to calculate the asset turnover. So we're looking at net sales revenue divided by average total assets. Well, if you remember, you didn't have a number here that said average total assets, but what you did have is you had a line for total assets and you had the beginning balance and the ending balance. And all we're going to do is to find a simple average. So we're going to add the opening balance and the ending balance. So this was the end of January 2013, and this is January 2014. So I want the oldest balance added to the newest balance and divided by 2. That's all I want. So now if I go here, I've got that. I've got the balance, 52,263, and you'll see that's the balance now. That's the ending balance. And then I'm going to add it to the opening balance and then divide it by 2. And when I do that calculation, I'm going to get 1.88. What does that mean? It means it tells us, first of all, just the ratio in and of itself. It gives us the amount of sales revenue, net sales revenue generated by every dollar that we invest in assets. So it tells me that for each dollar I invest in my assets, I'm generating from those assets $1.88 in revenue. And again, if you had to do a question just like we did with one of the previous questions, remember that the bigger the asset turnover ratio from one year to the next, the better. Why is bigger better? Well, because it means if this number here is getting bigger, it means that your assets are being used more efficiently, more productively. So for all the assets you have, it's generating even more sales revenue, right? So this ratio gets bigger when your net sales revenue gets bigger. So your average total assets are generating more revenue. So bigger is better. Okay? Now, we also asked you to calculate the return on equity. Now, again, just showing you your formula sheet, you do have a number there for return on equity, right? Or right here, your formula. Net income divided by average shareholders' equity. So what I did is I went to your requirement here in your question, and I said, well, I'm going to take the net income and divide it by my average shareholders' equity, and then multiply it by 100. That's the way the formula works. So again, you'll see even on your ratio, okay, I just converted it to a percent, okay? And so now in this case, what do we have? Our net income and our data, we'll go back up here. What's net income? Net income is $5,761. But you'll notice on the balance sheet number side, we don't have anything that says average shareholders' equity. So how are we going to find shareholders' equity? Well, one of the things we know is that, just a hint, we know that assets equals liabilities plus shareholders' equity, don't we? So what does that tell us? Oh, just a minute. Equals liabilities plus shareholders' equity. So doesn't that mean the same as assets less liabilities equals shareholders' equity? And guess what? I do have my total liabilities right here, and I do have my total assets right here. So what I need to do to find my average shareholders' equity is I need to take my total assets minus total liabilities. That would give me my shareholders' equity for the year ended January 2014, which is the end of the year. And I'm going to do the same thing at the beginning of my fiscal year. I'm going to take my total assets and I'm going to deduct them from my total liabilities, and that's going to give me total shareholders' equity to begin the period. So to open the period, or to begin the period, I'm going to take my assets less liabilities, which is shareholders' equity, add it to my assets less liabilities at the end of the year, and then I'm going to divide it by 2 to get the average. So there's the hint. So let's do that. So you can see here what I've done is I've done that math. So for the beginning of the year, what I did is I took 44,405. Okay, so even if you had your calculators handy, you might want to do this as I'm talking about it. Less my liabilities, which is 17,496. And that difference is going to be what? That difference is 26,909. That's at the beginning of the year. What is it at the end? Well, I'm going to go and get that number. I'm going to go here and take my assets, which are 52,263, and I'm going to deduct my liabilities, which are 27,233, and that's going to give me $25,030 in shareholders' equity at the end of fiscal 2013. So when I go here, that's the number I've got. So now, if I add these two numbers together, like I'm telling you here, and then dividing them by 2, and I take 5761 divided by that, I'm going to get 22.18%. Now, what does return on equity tell us? It tells us, just from this formula here, it's the amount of net income that we earn for each dollar that shareholders give us or that we retain in the business. So for all of the retained earnings I have and all the money the shareholders have given me, for every dollar that they've given me, how much net income do I generate with what they give me? So this tells me here that for each dollar contributed by shareholders, right, shareholders or retained in the business, I create 22.18% or 22.18 cents in net income. And again, the more net income I can create, the better. So bigger is better in this instance as well. Now, let's go calculate the next ratio, which is the inventory turnover ratio. So if we go back to our formula sheet, we see inventory turnover is cost of goods sold divided by average inventory. Well, if you remember in our question, we do have a number for cost of goods sold. It's right here, 61,054, and we're going to divide it by our average inventory. So again, we're going to take our ending inventory at the end of fiscal 2012 and add it to our inventory for fiscal 2013. So we're going to add the opening and the ending and divide it by 2 to get our average. So let's go down to our solution here, and we did that. We took 12,822, which you'll remember was our ending this year, and added to our opening, which is 11,401, and divided by 2. That gives us $12,111.50. We're going to divide 61,054, which was our cost of goods sold, by that, and we're going to get 5.04. What does that mean? That tells us how frequently inventory is bought and sold during the year. So what that means is it tells us how many times during the year that we sell our inventory. So the more times we can sell our inventory during the year, that's good. So the bigger this number is, the bigger this ratio is, the better, because it means any inventory that we're buying to resell, the more times we can sell it, the quicker it is we'll get our money in, right? Because the more we're selling, the more we should be able to collect from our customers, right? So bigger is better. Now, the other thing they ask us to calculate is the current ratio. The current ratio, if we look at our formula that you'll get on the exam, it gives you the current ratio as current assets divided by current liabilities. So now, if we go back to our question, we do know current assets. We know it at the end of the year and at the beginning of the year. We know current liabilities at the end of the year and at the beginning of the year. They asked us to calculate them at January 26, 2014. So we're only going to worry about this column, right? Because we don't have to take any averages. You remember when we did the other ratios, we needed an average. We needed an average. We needed an average. Here, there's no average in the current ratio. So I'm only going to calculate it, of course, for this year, which I'm going to take my current assets this year and divide it by my current liabilities. So when I go and do that, I'm going to get 1.39. Now, how do I interpret that number? Well, first of all, the current ratio measures the company's ability to pay off its current liabilities using its current assets. So, if you had more current liabilities than you did assets, you wouldn't have enough assets to pay those current liabilities, and this ratio would be less than 1. In your case, you have more than sufficient current assets to pay your current liabilities. You got $18,000 in current assets and you only have $12,931 in current liabilities. So your current ratio is 1.39. That means the company has 1.39 times more current assets to pay down its current liabilities. You have 1.39 times more current assets than you do liabilities. So again, the more current assets you have, the better, because you'll be in a better position to pay down your current liabilities. So again, bigger is better. Now, let's go calculate another ratio, debt to asset ratio. What does that mean? Well, on your formula sheet in the exam, you're going to see we give you your debt to asset ratio. It's total liabilities divided by total assets. So let's go to our question. At this date, January 26, 2014, we're going to take our total liabilities of $27,233 and divide it by our total assets, $52,263. So let's see what that gives us. If we go down here, that gives us 0.52. So what does that mean? This ratio tells us the portion of our total assets that are financed through debt. You want this ratio to be as small as possible. Why? Because the more assets you buy, if you have to finance them by getting debt or borrowing the money, don't forget you're going to have to pay interest on that money. It's going to cost you more. So if you have any money that you can put down when you purchase your assets, it's less debt you have to carry, right? So this ratio tells us the proportion of our total assets that are financed by our lenders, people who lend us money, or it should say creditors here, right? So this tells us that 52% of the company's financing is from lenders. So that means only 48% of it is coming from shareholders. So again, that means that 52% of my financing of my assets is coming from liabilities. So for every dollar in assets I have to borrow 52 cents for every dollar in assets I have in order to buy them. So that means the other 48 cents or 48% of all the assets that I purchase are coming from my shareholders and any money that I've retained in the business, right? So if you're going to have to borrow more than you can bring to the party, so to speak, or you're getting from your shareholders, you're going to be racking up more debt. So in this case, your debt to asset ratio, smaller is better. Now, let's go calculate the next ratio, which is our net profit margin. If you look at your formula sheet, net profit margin is equal to net income divided by net sales revenue. So let's look at what this means. Net income is $5,761. Net sales revenue is $90,837. Those are the numbers we need to calculate the net profit margin. So let's go down here. Net income is $5,761. Net sales revenue, $90,837. And then take that and multiply it by 100%. That's going to give you 6.34%. What does the net profit margin tell us? It tells us the percentage of revenue that remains after we pay off all of our expenses or after we deduct expenses. So it tells us the percentage of revenue that stays with us after we pay off all of our expenses. So this tells us, obviously, we want more of our revenue to remain with us after we cover our expenses, right? So this tells us that 6.34% of our revenue is left after expenses are covered. So of this net sales revenue, we get to keep, for every dollar in net sales revenue, we get to keep 6.34 cents. Obviously, we would want to keep in our profits more if we could. So bigger is better. So again, this number represents, the net profit margin represents the percentage of revenue of that net sales revenue that would remain after we cover our expenses, because revenues less expenses are net income. So how much of that net sales revenue is going to be left after we cover our expenses, right? So the bigger, the better. Why? Because we would be keeping more revenue in our business, right? The more we can keep in our business after we cover all of our expenses, the better we are. The more profit we'll keep, the more retained earnings we'll have, so bigger is better. And the last ratio we want you to calculate is one that we've done many times in class, gross profit percentage. So what does that mean? Well, if you go to your formula sheet, gross profit percentage is net sales revenue minus cost of goods sold divided by net sales revenue again. Now, the numerator you should recognize, net sales revenue less cost of goods sold. When we did our multi-step income statement, that's gross profit. So this ratio is really the numerator's gross profit divided by net sales revenue. So let's go ahead and see how we calculate it. Well, if we go back to our data in our question, gross profit is net sales revenue less cost of goods sold, and then we're going to divide it again by net sales revenue. So if we did our calculation down here, we'd see that's net sales revenue less our cost of goods sold divided by net sales revenue times 100 to get it as a percentage, and that's going to give us 32.79%. What does that ratio mean? It tells us how much profit was made for each dollar of net sales after cost of goods sold is deducted. So in other words, how much gross profit did we make, right? How much gross profit did we make on each dollar we sold, on each dollar in net sales revenue, right? So for each dollar of net sales revenue, what percentage of it was gross profit? And that's important because don't forget when we did the multi-step income statement, you saw it. This numerator here is gross profit. It's from that gross profit that we're going to deduct all of our expenses, right? So we need to know how much gross profit we have in our business to cover those expenses as a percentage of net sales revenue. So obviously the bigger gross profit, the better. So bigger is better. But what does our number tell us? We get a number of 32.79. It means that for every dollar in net sales, the company made gross profit of 33 cents, approximately 32.79 cents, or rounded upward to the nearest cent, 33 cents of every dollar in net sales was left to cover the operating costs. So you want to make sure this number is as big as possible, so you make sure you have enough to cover your operating costs. So bigger is better. So that concludes our series of calculations and interpretations on the ratios, okay, for this question. So hopefully you found this to be a little bit of help to you.